I recommend that everyone read this book. It's by Nelson Nash, and it's called Becoming Your Own Banker, Unlocking the Infinite Banking Concept. What I'd like to do is just read some highlights from the first page, the introduction to this book, to highlight and expand on some of the concepts that he's going to talk about. First of all, he says, Becoming Your Own Banker, the Infinite Banking Concept, is a text for a 10-hour course of instruction about the power of dividend-paying whole life insurance. Dividend-paying whole life insurance is a little bit different than, say, a typical whole life insurance policy. A whole life insurance policy is made up of about 95% death benefit and 5% savings component. With a high cash value insurance policy, a dividend-paying policy, what we're talking about here is a policy where, say, 60, 70, 80, sometimes upwards of 90% of that policy is going towards savings, and 30, 20, 10% is going toward purchasing insurance, the death benefit portion. What makes this so powerful is that the IRS has sanctioned this, and if used properly, you get the non-taxable benefits of it. You get unlimited growth. You get dividends, like he just said, paying out that are also non-taxable. The idea is to keep this from becoming what's called a modified endowment contract, or a MEC, and you have to follow certain IRS guidelines to do that. This book is not a sales tool for life insurance agents. It is an education that the life insurance industry should have taught during the last 200 years. In other words, he's rebuking the very industry that he's using, because he says, unfortunately, the industry, the life insurance industry, has concentrated on death benefit qualities of the contract and has neglected to adequately describe the financing capabilities that it presents for the policy owners. In other words, what he's suggesting here is that most insurance companies, and therefore their agents, have focused on the death benefit. You know, they get that sad countenance and they say, gee, Papa San, what happens if you don't come home tonight? What are Mama San and the kidlets going to do? That's what turns us all off to the insurance industry. I mean, come on. I get on a plane, and if I want to read a book and not chat with the person sitting next to me, when they ask me, well, what do you do for a living? I say, I sell insurance, and they shut up, right? This is the problem with insurance, as I just said. A typical whole life policy, 95% of it is buying death benefit, and only 5% of it is buying the savings. And we invert that with a high cash value insurance policy so that we can have a banking policy, i.e. private equity banking. Ironically, life insurance companies must put premium income to work in various investments in order to pay the death claims. In other words, what ends up happening is we pool all of the premiums that get paid into a life insurance policy to a company, and then they're able to take that large pool of money and go invest it in ways that you or I wouldn't be able to do individually, because there's now so much money available. He then goes on and he says, this book demonstrates that your need for finance during your lifetime is much greater than your need for protection. In other words, death benefit. Let me reiterate that. This book demonstrates that your need to finance your lifestyle during your life is a much greater need than the amount of money you need set aside in a death benefit to protect your family. And a lot of people just do not ever get that concept. And that's what this book helps people understand, is that this isn't about this monstrous death benefit that you end up with. In fact, he says that right here. Solve for this need, in other words, your ability to finance your lifestyle through this instrument, i.e. insurance, and you will end up with more life insurance than the companies will issue on you. What he's saying there is that just like, say your truck, you got a $50,000 truck, right? You can't go buy property and casualty insurance for $500,000 on a $50,000 truck, right? Because then you get in an accident and you get paid $500,000 for a truck that's only worth $50,000. Again, insurance is made to replace what would have been there. And so what they say is that the insurance companies say with life insurance is, well, how much is this person making? And then they have a multiplier that they say, okay, well, if you're making $100,000 a year, then we'll multiply it by 20 or 30, depending on your age, X, 20 or 30 X. And that's how much death benefit the value of your life would have over time. And so they cap the amount of money that you have. So somebody making minimum wage can't get a $25 million death benefit, then die and leave their family $25 million, right? They don't allow that. So the death benefit has to be commensurate with the amount of income you're making. That said, let me reiterate what it says here. Solve for this need, your need to finance your lifestyle, through this instrument of life insurance, and you will end up with more insurance than the companies will issue you. Because because of IRS guidelines, every time you put money into one of these policies, even when you're putting the money into the savings amount, they have to increase your death benefit. So on my policy, if I put in $60,000 toward the savings portion of it, I end up with $90,000 more in death benefit. And that's just the math on mine, right? So they have to do that to stay compliant with IRS guidelines that were put in place in the mid-'80s. Most everyone is familiar with the fact that one can borrow from a whole life policy. Now, a traditional policy might take 5 to 7 years before you can do that without penalties. But in a high cash value policy, you can begin to borrow immediately. But because of how little premiums they pay, there is limited access to money to finance major items during a lifetime. In other words, if you have a typical whole life policy where only 5% of it is going towards savings, it's going to take a really long time to get to a point where you have enough money there to finance your lifestyle. But with a high cash value policy, like I said, where 60, 70, 80% of that money is going toward the savings, it really doesn't take that long. I have over 300,000 now, and I've been putting money into my policy for only 4 years. Yet the need for financing for a typical person is extensive. Really, all this book adds to the equation is scale. Yesterday, I was texting with my son who said, yeah, the banks love my company now. And I said, well, yeah, anybody that pays interest, the banks are going to love. And he said, yeah, I hear that. And I said, well, that's why I teach people how to become their own banks. So they don't have to go to the banks and pay high interest. Yeah, but I don't need the insurance, he says. Back to that typical mindset of, well, I don't need insurance today. Why? Because he's young and healthy, right? He doesn't see himself needing it. Besides, he's not married, and he's like, well, who am I going to leave this money to? But this isn't about the death benefits. It's about having the money he needs. In this case, he started a new company, right? And he does have to have financing to buy the equipment that he's installing at people's homes. So the fact that these principles inside of insurance policies have been there all along, but no one taught them to him, is very frustrating. I wish I had understood it a long time before I did. Had I known them, life would have been much simpler and more profitable. Someone should have recognized these inherent principles and taught them long ago. But this didn't take place because of the mindset that predominates the entire financial world. Well, what is it the financial world tells us? If you need money, put it on a credit card. If you want it now, put it on a credit card. If you need to borrow money for a car or a major item, well, go borrow it from the bank. That's what we're taught. And what we're going to teach you here is that you can put away money little by little by little, whether it takes a year, 2 years, 5 years to get to a sum where you've got enough to buy major items. So you may start out with small items, like just paying off credit cards. Again, I'm going to go into that right here. This book is written for the layman. Again, I recommend this book for anybody because it is written for the layman, not the financial advisors. But all life insurance agents should be thoroughly knowledgeable of its content and practice. Unfortunately, they aren't. Again, unfortunately, this isn't the case. Most insurance agents that I talk to have no idea how to do this. Very few of them have more than a rudimentary understanding of its qualities. Now, this is the most important part. The whole idea is to recapture the interest that one is paying to banks and finance companies. This is the key to high cash value insurance policies, is that we're going to swap out that credit card interest rate at 26 or 29% for something that's less than 1%. We're going to swap out that student loan debt at 6% for something that's less than 1%. We're going to swap out that home loan that's at 4, 5, or 6%, or even if it was back a couple years ago and it was at 3%, for something that's at less than 1%. That's what we're doing, is we're swapping out expensive money for much less expensive money. That is the key to the whole concept of high cash value private equity banking. So let me reread this. The whole idea is to recapture the interest one is paying to banks and finance companies for major purchases in our life. Well, that's what he says. But again, you can start by just paying off a credit card that's at 29% and only $1,500 worth of credit card. I'll reread that. The whole idea is to recapture the interest that one is paying to banks and financial companies for major items that we need during a lifetime, such as automobiles, major appliances, education, homes, investment opportunities, and business equipment. As I stated, you can begin by just paying off debts, that $1,500 credit card that's at 29%, and swapping it for an interest rate that is a net effect of less than 1%. In other words, they're paying you on your cash value 5.3%, and you can borrow at 6.2. The difference is 0.9%, so less than 1%. Again, ignore the specifics on those numbers, but understand that's how it turns out usually. This book is not about investments of any kind. Let me reiterate that this book is not about investments of any kind. It is about how one finances the things of life, which can certainly include investments. In other words, once you've paid off all those credit cards, once you've traded out 29% interest rate on credit cards and got those wiped out by trading it out for something that's net effect of less than 1%, now you've got a nest egg, right? Which can certainly include investments. So in the beginning, you might just be wiping out, like I said, credit cards and debt. And then here's the cool thing. Once you've paid off all those debts, and most people can get completely out of debt. I mean, 100% out of debt to include their mortgage in 5 to 7, sometimes 9 years, right? That includes a 30-year mortgage, right? So once you've done that, instead of being at zeros like you would if you were doing the snowball method that some people teach, now you'd have this nest egg of $300, $400, $500, $600,000 sitting there, which is still growing at, say, 5.3%, right? And then you can leverage that money to go and buy investments, a duplex, a fourplex, start a new business like my son was doing, right? It is not about rates of return. So I want to be clear about that. Although I just said some numbers, those numbers really mean nothing because as time goes by, interest rates are up and interest rates are down. But the process of banking goes on no matter what is happening. Okay, so please understand that just because something might be at 5% today, if interest rates get higher or interest rates get lower, it doesn't matter. It's the concept of banking on yourself that is so important. It is a well-known fact that banks make more money during times of low interest rates than when rates are high. He then goes on to say, well, okay, here's a word of caution, though. You're going to see these illustrations, and please understand it's not about those specific numbers. But in comparison to these other ways or other methods of financing, going to banks, credit cards, etc., the things of your life, the difference in the results remains the same. So it doesn't matter whether interest rates are at 29% or at 5% or whatever. The concept of borrowing against your own money, because you end up with two pots of money here. You have your cash value that continues to increase and get an interest rate, and then you've got the money that you're borrowing from the insurance company, which is a separate pot of money. So one is always growing and one is shrinking as you pay it down. That is the concept that ends up being important here. It is not a procedure to get rich quick, okay? To the contrary, it requires long-range planning. I tend to think 70 years in the future, I won't be here and neither will you, but there is no reason not to behave in that manner. Plan as if you're going to live forever and live as if you're going to die today. Appears to me to be a good thought. One can learn how to plan and act intergenerationally. If you've set up this banking method for yourself, when you pass away, you are going to get a tax-free death benefit. And if that death benefit is placed inside of a proper trust, that can then become the bank for the rest of your family for many generations to come. He says, becoming your own banker is not a tax-qualified idea of any sort. In other words, it's not a 401k or a Roth, although it does have IRS guidelines. So don't misunderstand that. There are IRS guidelines. We must follow those guidelines. Otherwise, the IRS looks at this and says, oh, well, this isn't an insurance policy. This is an investment. And if it's an investment, we are going to tax you accordingly. So yes, an insurance agent like myself must follow certain IRS guidelines that are imposed upon these policies. Otherwise, it will become taxable. And the whole idea is to keep this thing tax-free. Life insurance has been around for over 200 years and is not a creature of any tax code. Now, again, somewhat correct, somewhat not. He wrote this book in the early 80s, and in the mid 80s, the IRS did come back and put some guidelines on what can be done here because there were people taking advantage of it. So basically, the IRS code says, look, you have to have so much death benefit versus premium for the life of this thing. So as I just said, if I put in $60,000 into my policy, they end up giving me, I've looked at the numbers and it's about $90,000 more in death benefit. So there's always going to be a ratio of death benefit to premiums. And that's why he said you're going to end up with more life insurance than the insurance companies would have given you in the first place. It is nothing more than like-minded people contracting with one another to solve a financial problem. Like-minded people. We only use mutual companies. Yes, there are many stock-based insurance companies, but the fiduciary responsibility of the executives in a stock-based company are to the stockholders, which aren't necessarily policyholders. We only use mutual companies, and mutual companies, the executives in those mutual companies, their fiduciary responsibility is to us, the policyholder, because there are no stockholders, there are only policyholders. And so if they're making money through dividends, we're getting that money back. And so we only use like-minded people that want to be with a mutual company. And then the insurance company, the mutual company that we're working with, has a larger pool of money that they can go invest in a way that you and I could never accomplish because we don't have the millions or tens or hundreds of millions. Well, they've got billions of dollars that they can go invest. We would never be able to accomplish that on our own. Okay. There's no such thing as having too much money in the bank. Wealth must reside somewhere. What better place to have it reside than here in an insurance policy? That is the key. You got to put your money someplace. I chatted with a gentleman yesterday who has $400,000 in his regular bank account. We know the FDIC doesn't protect that much money, right? And so if something happened to his bank and the banks are, struggling, he would lose for sure if he even gets back to 250, and that would come over time. It's not going to happen tomorrow if his bank were to fail, like Silicon Valley Bank did earlier this year or last year. So wealth must reside someplace. Why not put it into a place with like-minded human beings, and that the executives of those companies, those mutual companies, are using that money to help us get more money. That is their fiduciary responsibility, helping us make more money with the monies that we've put into the life insurance environment. That's what this book is about. Again, I would suggest everyone read it. I'll reiterate what it said on this right here. The whole idea is to recapture the interest that one is paying to banks and finance companies for major items in your life. That's the idea, to get to as much money as you can in there so that you can purchase major items such as automobiles, major appliances, education, homes, investment opportunities, and business equipment. This isn't about the amount of death benefit you get. It's about having enough money there to borrow at a reasonable rate, which is usually less than 1%, in a net effect of less than 1%. Enjoy the book. Give me a holler if you've got any questions. There's my numbers. Give me a holler, and I'll walk you through how this can actually help you.